Alright, we're just going to do a quick run through of the top 5 charts of the week. Just a selection of some of the best charts from the blog and social media. So the first one is speculative futures positioning across crude oil, copper, equity indexes, so aggregated across all the different US equity indexes, and treasuries and the DXY, but inverted for those last two because essentially they kind of operate in reverse to the previous three. Now, thinking about all these 5 different instruments or futures, what do they have in common? Well, long oil, long copper, long equities, short treasuries, short dollar. This is basically the reflation trade because, crude oil, copper, well, especially crude oil is very much linked with inflation. Treasuries do poorly in environments of improving inflation and growth. Equities obviously do well in an environment of improving nominal growth. And copper likewise benefits from activity growth and an inflationary environment. So this is basically the reflation trade positioning indicator. And the fact that it is so high, basically is a measure of how confident traders are in the whole reflation trade idea, the whole reflation trade theme. And, it's one thing to be confident, the other thing is, being overconfident. And there are times in the market where overconfidence, extreme optimism is well justified. But a lot of the time when you see extremes, it can actually be a turning point. So that's the risk here. That's what I'm kind of flagging. But for now, you look at the data. The data is really actually consistent with solid growth. So, I would say that it's at least partially justified. Moving on to number 2, US dollar yield support indicator. So this red line here includes the signal from the nominal cash rate differentials, real cash rate differentials, and the shadow cash rate, which is the normal cash rate adjusted for the impact of quantitative easing, and the 10-year bond yield differentials. Now, interesting thing about, interest differentials for currency markets is that there's something that kind of works until it doesn't, or it doesn't work until it does. You can see here that this yield support indicator has worked remarkably well at times, and at other times hasn't really actually been that useful. Of course, there's usually when it's not being that useful, there's other things going on. So that's why it's difficult to take a pure quant approach with these kind of macro markets because just drivers can change, and the qualitative color around the background is just so important. So and that's why my personal view, my preference is to take as many indicators, be as data driven, as quant driven as possible, but knowing that you need to take that qualitative judgment aspect and be constantly figuring out what you should be paying attention to, what new indicators that might need to be added to the mix. Anyway, the bottom line on this chart, we've got that classic alligator jaws kind of thing here going on. Yield support indicator is very bullish for the US dollar, and this big sort of counter trend move or start of the new bear market is taking it far away from where the yield support would suggest. Now, we did have a situation like that in the mid-2000s, but then it's provided a pretty good lead at other times, like in the reverse in .com. After the .com boom, it was tapering off quite substantially, whereas the dollar headed higher until the gravity of yield differentials took it back down to earth. So there's definitely a short squeeze underway here, but when I look at this chart, I think certainly if you just want to think about risk scenarios, that's definitely a risk scenario that seems to be in play now. Number three, kind of an interesting chart here. It's from Thomson Reuters data stream, the IBES estimates. These are the gold standard for earnings estimates globally. And what it is here is the consensus estimate of long-term average growth rate. Quite an interesting chart really, because on the one hand it's like something that's very fundamental, very something that's probably a certain amount of bottom-up basis to it. Being the consensus of a lot of analysts, you'd think that a lot of science is going into it, but you can see here that there seems to be quite substantial gyrations, especially during this period, but especially during the dot-com boom, where there was just massive enthusiasm about the new economy, and people went from just plugging in around 11%. That's probably the long-term growth rate, but just say 11%, and then actually no, maybe it's more like 18-19%. And then of course once the enthusiasm waned, came back down to that 11%, and then we've had these sort of structural things like there was a fear of a Great Depression, and that brought the future earnings outlook down, and the whole secular stagnation meme brought it down as well. Then reflation brought it back to where it should be, arguably, and then the tax cuts blew it up to the upside. So there's a certain question there to be asked of whether it's too optimistic at the moment, being what appears to be a sentiment indicator, back at in 2009 and in 2016, when all hope was lost, that it turned out to be good buying opportunities. And when it was at its best, that turned out to be a good buy opportunity, as in waving goodbye, I'm out of here. So interesting chart. Number four here is the long-term growth rate. So just a quick note on the methodology here. This is the rolling 10-year CAGR, or CAGR, compound annual growth rate. So that is, for example, in the latest, it's what it would be. It would be the March quarter of 2018 divided by the March quarter of 2008, and then you annualize that by so it's that divided by that, and then to the power of 1 divided by 10, which takes a 10-year growth rate to a 1-year annualized number. Just a little bit of financial maths. Anyway, it's a 10-year growth rate basically, and quite interesting to see that in the 70s, 80s, very high growth rates compared to where we are now, and that tapered off a bit. And then you had the crisis come along, and then that made massive big damage to it. And you can see there that for quite a number of years, like 5 years, investment growth, employment growth on a 10-year basis was very, very subdued. But now we're starting to see a pick up there, and that's consistent with what we're seeing in a lot of the surveys, a lot of the data, where companies are actually starting to invest again. They're starting to pick up hiring. Job market's looking quite tight in America. So it's a very interesting chart there. It may be a false start, but if we see that pick up to where it used to be, that could be pretty important, because you think about investment, capital expenditure, employment. These are the key inputs to production, and there's only so long that you can get away with not investing in productive capacity. And future growth rate is going to be driven by investments in this today. Last but not least, listed companies versus investment funds. Quite an interesting chart here. It's part of a article that had a few other charts that were similar kind of line of inquiry. It shows you here the number of listed companies and the number of US equity investment funds. So that's including mutual funds, exchange traded funds, and closed-end funds. That's from the ICI fund data. It's the count, so the number of those funds, and it's all US equity, US domestic equity investments. So I didn't count any international, global, or regional. And yeah, really quite interesting. So you've gone from about 1,000 to about 4,000, so a fourfold increase for number of US equity investment funds, and the number of listed companies went down from a peak of about 8,000 to almost 4,000. So you've almost had a halving there versus a fourfold growth. Quite, it's interesting too because it reflects a changing landscape, a changing approach. If you one implication at highest level of this is that investors have more choice of funds than they do of actual stocks, which the funds invest into. It's kind of I don't know if you call it perverse, but maybe it just reflects a change of preferences by investors that they've given up on stock selection and decided to just focus on either buy and hold or market timing by just going into the funds themselves. It's certainly food for thought. But anyway, I will leave it there. If you want to read any more about any of these charts, you can click the link. We'll put the link to this web-based version of the email into the YouTube video. But if you wanted to receive this weekly free email in your inbox, just go ahead and I will put this in, as I said, and then there's a subscribe button at the top. You can just click the subscribe button. You can do it down here as well. Anyway, yeah, or on the website you'll find the subscribe box and you can get onto it.